So today's cardinal lesson, we're talking about RMDs, required minimum distributions, that you're going to have to start taking at age 73, or if you're already there, you understand a little bit about these. We're going to be defining them, going over the rules, and we're going to talk about some strategies that we use in our financial planning practice. So just on a personal note, I had an accident a couple of weeks ago where I wish I had a good story that I was, skiing on a black diamond or something out in Colorado, and I broke my leg or whatever. I mean, I was getting into a golf cart uh, playing, and I slipped, fell, busted my knee. I broke the quadriceps tendon. Was torn. I had to have surgery. I'm going to be having it elevated for several weeks, and so the show kind of must go on. So I'm just letting everybody know I'm working with Tom's at the office. I'm here. Thomasina's in the studio, and the show's going on. So back to the show. So RMDs. So why are we doing a special show on RMDs? I mean, in our practice, we get a lot of questions from people that, well, when do the RMDs start? Or people tell us they start over 70, and they used to start at 70. Now they start at 73 for most people. People born in 1960 or after, they're 75. And then people, once we define them, we get people, how much is that RMD? And a lot of times people don't have a clue. And I just kind of generally use the number of 4% just to give them an idea and look at their IRA balance now. Um, so we're doing this just really to define them better for people. And I want to bring Tom on to talk about what's the why. Why are we doing this? Why are we making a special show over RMDs?
Yeah, I mean, I think we want to do this show because if you don't have a plan for distributions of your IRA, you default to the government's plan, and that's what this is. This schedule, these percentages, that's the government's plan for how you take out RMDs, which might not be in your best interest. So we want to go through sort of what those rules are, and then what are some strategies you can do around that. I do want to bring up the show notes here real quick. You can find these below the video on YouTube. They're also on our website. We have the board, especially how we have the filming now. It's probably pretty small, so you might want to print these out and take a look here. But we have sort of some rules. We're not going to spend a lot of time on this piece of it in the show today, but there's some different rules around how you can aggregate your IRAs or which accounts you can aggregate to determine your RMD. If you have questions, go refer to this. But what most of the show is going to be on is this table, this uniform life table. This is the table that the government sets out, they produce, that shows you how much you have to take out. It's a certain percentage. As you get older, that percentage goes up. So we'll spend some time talking about that. We have one other chart here. That's not today's shows, but this is the chart you would use if you inherit an IRA. We don't want to get too off on this, but this chart is also in the show notes.
Okay, so we take RMD. I don't like using acronyms too much on our show because acronyms confuse people that are just learning subjects for the first time. But this is a pretty generally used one. So you might as well learn, and we're going to use it in it. And let's break it down. It's required minimum distribution, those three words. So the first word is required, and that means the IRS, the government, the people that tax the IRAs, is you're required to do this. Okay. There's plenty of time for optional distributions, or you can take money out of these things once you get to be 59 and a half and just pay the taxes. Um, but the required word is just what kind of gets people's hair standing up. And then the next word, minimum. So the IRS defines a minimum amount that you have to take out at a given age. Not a maximum, not an average, it's a minimum. So we got required, must do it, minimum, at least this much, and then the word distribution. So you're doing this one for the government. And as Tom said earlier, people that just wait till 73 and then they just take the minimum, that's already laid out for you. You don't need to do any planning with us. It's just because it's just, you can wait till 73 and we'll do the math for you. And there you go. Now, if you look on the left side of the board here, Yet you can see that age 73, people ask us a lot, well, how much do I have to take out? Well, and I rounded up to 4%, but at age 73, it's 3.77%. And 3.77% of what? It's going to, like, if you're 73 this year, whatever your IRA balance was December 31st of 2023, when you finish the year, and your custodian will tell you this right on the statement, that you had $423,000 and $211.26. I mean, it's just whatever your balance was the end of the prior year, and you multiply that times 3.77%. That's the amount that you're required to pull out and pay taxes on. Okay, it's just that simple. And so the government is wanting their money, and they're saying, you've enjoyed tax advantages on this long. Now, our silent partner here, the IRS, your silent partner, is calling their chips in. So, doesn't mean you have to take 3.77%. When I'm calculating these for people, a lot of times I round them up to an even thousands amount just to make sure I got a little fudge factor. I also want to point out under the rules, it talks about IRA account aggregation. So, if you have multiple IRAs, which many of our clients end up with multiple IRAs because we create different streams of income for them. And if you have multiple IRAs, you're able to calculate your minimum or your RMD on the whole pie. So you can take the total number of the balances last year and then multiply it by the RMD percentage. And then the aggregation part, you could pull the whole amount out of one of your IRAs. So we do this frequently when we're setting up cash flows for people, where they have several IRAs. Some of them they're letting grow. Some of them they're distributing immediately. And we have another account that just has some money sitting in it or invested in it that is designed to pull out minimum distributions in case we don't want to hit one of these other accounts. So, and you can't do aggregation with 401ks or 403bs or some other type of retirement account. The aggregation is only for IRAs. Okay. Now, the Roth IRA, which we've had several other videos on the Roth IRA, is tax free. You've already paid the tax on the Roth at the time of contribution, at the time you started it. So the whole amount in there, the principal is available to you tax free, and then the growth is tax free as well. And then there are no RMDs on the Roth account. So the Roth is going to be a way, and you'll see it over in the strategies, to reduce the effect of these RMDs. So if you do Roths earlier, you're not going to have to start withdrawing from them at 73. Now, there is a little difference of the 73. So the people born before 1960, let's just make it that simple, they start at 73. And then the people born 1960 and after, their RMD age is 75. And there isn't a whole lot to talk about the rules. I mean, there's a bunch of little small rules that we're not going to dwell on here. But I just want to refer to Tom. Is just generally speaking, when we're talking about how RMDs work when you have to take them, did I miss anything or do you want to emphasize something, Tom?
No, I mean, I think that that's pretty accurate. And so I think one of the points I just want to hit on again is how you calculate the RMD is you take the balance from the end of the prior year. So they do this every year, they recalculate this RMD. And so if the balance is going up and your percentage is going up, you have a higher dollar amount you have to take out each year. But they look at the year, what age you turn in that year. So let's fast forward. Someone's been taking RMDs, and maybe I'll just say maybe I fast forward. I'm turning 75 this year, which is clearly not accurate, but I'm turning 75 this year, and my balance was $100,000 in my IRA as December 31st of last year. Is you would go to the chart, you would look at the age 75 percentage, and you would look at the 100,000 and you would do the math. And that's how much you have to take out. It needs to be taken out by December 31st of that year. So you can't get into the next year to do it. A little bit of the first year, they give you a little bit of wiggle room. But generally speaking, you need to take it out by December 31st of the year that you have to take it. And you're just sort of on the schedule and you do it sort of ongoing. One other point I want to make is once you get to RMD age, once you either get to 73 or if you're a little bit younger to 75, is once those start, you cannot do a Roth conversion on the RMD. You can still do Roth conversions in that year, but you have to take the RMD first. So let's say your RMD was $10,000 for the year. You have to take that out. You have to pay the taxes on it. You can't convert it to a Roth. And any Roth conversions would be after you have taken the RMD out. So that's just something to. Some people say, well, when I get there, I'll just convert it to a Roth. It's like, well, it doesn't quite work that way. You have to take it out, pay taxes, and you cannot convert those.
Okay, so now we move over to strategies. And by strategies, we mean if you don't like being on the government's plan, just principally, or you are thinking maybe you want to take a little bit out sooner, you want to do some ways to planning around all of this, we're going to just talk about some strategies. First and foremost, some people don't have this luxury. I mean, a lot of people that come to us that are retiring and they're 65 or 67 or 63, and they've got this IRA that they haven't paid taxes on, and they need to start living off of it. So that in and of itself is an RMD, is an RMD. If somebody's pulling out 30,000, 40,000, 50,000 a year, and we got a plan for that every year, well, then they're reducing their IRA balance just by definition that they're spending it on themselves. And then, so the balance is coming down. And when they get to be 73, 74, 75, that amount they're pulling out of to live on more than covers this minimum distribution over there on the left side of the chart. So just want to point that out, is that some people are not this fortunate where they just to have the money and have the choice whether they pull money out before 70 or in the early 70s. But for those that are in the situation, let's start out with the strategy number one is I just put down start sooner, enjoy it. I mean, we get into a discussion, Tom and I do, with people that are coming in, they're doing financial planning, they're hiring us to have a discussion, put together a plan so that they can plan out all their taxes and income, cash flows, make sure they're not running out of money late in life, that sort of thing. And we ask them when they get over this IRA, where a lot of their assets are typically in the IRA, but they've figured out how to live off of their Social Security and their other money. I start asking them, well, what's this money for? And I get a lot of weird looks where people at first like, what do you mean, what's it for? Well, I mean exactly what I mean. What I said, what's it for? And and then we kind of get, well, oh, it's for my retirement. Okay, well, so if you're for retirement, you're retired or retiring. Why aren't you spending any of it? Well, I don't want to pay taxes. I mean, a lot of folks have not really allocated their IRA money. They haven't figured this out. And it makes sense to have a distribution plan, if nothing more than the taxes. Is like, when are you going to pay these taxes? And if your only answer is just as late as possible, I want to avoid them and not pay the taxes. So that's what it's for. It's just for accumulation and not paying taxes. Well, and that doesn't work for me. I mean, it's just, so that's what we're doing. That means it's not for you. You're not going to have a plan to use any of it. So if it's not for you, it must be for somebody else. It's for your kids or for your spouse or for somebody after you're gone. And if that's the case, then you really don't want to hand your kids a tax problem. I mean, you just, at least I don't think you do. So let's look at strategy number one, start sooner and enjoy it. So you can pick an amount. Maybe it's $20,000 a year if you have a good sized IRA. And if you make $100,000 a year or $80,000 a year or 70, um, you're not going to pay a lot of taxes on 70, 80, $100,000 a year in retirement, especially if part of it's Social Security. But there's taxes there, and you could pick an amount of like 20,000. I'm going to start taking out now, and I'm just using it for instance. If you had a $500,000 IRA or a $700,000 IRA or more, you could pick like 20,000, pay the taxes, pay the state taxes. You'd be left with 14 or 15, and you could get together a plan to just make that enjoyment money. And if that's too troubling for you, give it away. Give it to your grandkids. Use it to pay for their education. Use it to pay for a house they can vacation on. I mean, so that first strategy is we do this with some clients that are so fine as we encourage them to make some withdrawals and pay the tax and then just use it. Okay. Second strategy, if that's too much for you, actually enjoying and spending some of the money, then you're a candidate for Roth conversion. Is we could sit here and we could take an amount. We have several other videos on this where we could take what you're spending, what you're earning, what you're paying taxes on anyhow, and then we could factor that up in the tax bracket to where you would fill up the 22% bracket or the 24% bracket or the 12%. You fill up one of these brackets, and you do that by doing a Roth conversion, and then you got to pay the taxes, and you either do that out of the IRA money, and then you'll have less will make it into the Roth. But nonetheless, now you'll have just pulled it out of the taxable account. It's not subject to RMDs anymore. And then you just deposit it in a tax-free account, and then it's there if you need it. And then you can just use it in a later year or just let it grow tax-free. So the Roth conversion becomes a strategy to lower ultimate minimum distributions and lower taxes in later years.
With the Roth conversion strategy specifically, like I mentioned earlier, you need to start that ideally prior to you getting to the age of needing to take RMDs, because once you get to that point, you have to take the RMD first. And so you can still do Roth conversions. It's just after the RMD is done. And so if we want to minimize or lower the RMD requirement, you need to do the Roth conversions prior to that. So you really have a window of time. Most people can start maybe around 59 and a half, depending on when you retire and things like that. So, we need to look at your specific situation, but you have a window of time between 59 and a half and 73. That's a lot of years there that you can do a lot of Roth conversions, lower the balance down, get it into something that's tax free, and not have to worry about RMDs on a large IRA balance. Plus, that factors in too that taxes will likely be higher in the future. And so we're paying taxes at the lower rate now, getting it into tax free, not having to worry about future tax rates, not having to worry about the RMD throwing you into higher tax brackets because you have to take it out. I mean, it's a great strategy if you start soon enough to really help minimize the RMDs in the future.
Well, sure. So now let's talk about the qualified charitable distribution, or the QCD. So the earliest age that you can start doing a QCD is 70 and a half. So it's before minimum distributions, but not a lot before it. So when you get there, and then from now on, you can donate money from your IRA directly to a qualified charity. We have a lot of seniors do this with their church, where they make their contribution to the church all in the beginning of the year. I mean, you don't have to do it that way, but procedure, it's simpler. You can give them up to $100,000, and it's a little more than $100,000. Most of our clients don't have a problem with that limit. They're much less than that, but whatever the number is you can donate starting at 70 and a half each year directly to a charity through a thing called a QCD, or qualified charitable distribution. And this will count as your minimum distribution for that year. and you're not going to pay taxes on that money. So, or it'll count as part of your required minimum distribution, or RMD. So I don't want to get too deep into that, but we have a number of clients that do this every year, and they call us to help, for us to help them and qualified. You got to do this stuff right. If you miss a step, you can you're going to end up paying taxes on the money. But you could donate your entire charitable distribution. And your kids, if they're your beneficiaries of your whole estate, you want to be leaving them after tax money or Roth money, because they're not going to have to pay taxes on that. And if you want to make charitable contributions, do it from your IRA through QCDs. Tom, do you have anything to add to that?
No, I mean, I think that's very wise. Is if you have, the QCD is not a reason to start giving to charities, but if you're already giving to charities, it's a wonderful way to give once you reach that 70 and a half age. And once you get to the 73 or the 75, the age that you have to take the RMDs, that gift to the charity can satisfy the RMD. So we have clients that are on this Roth conversion strategy. They've been doing it for years. They get to age 73 and now they start giving out of the IRA and satisfying their RMD requirement, not paying taxes on that, and they still have the same room to do Roth conversions like they've been doing. So, that's just an example. But if you are giving and you're 70 and a half, it needs to be it needs to be out of the IRA and not other money if you have IRA money available.
Yeah, and what we do in our financial planning, again, for people in their 60s, which is typically the age that people are coming into us, is we plan this stuff out for the rest of both of their lives if they're a couple. And I mean, people don't go with our financial plans to the number and to the penny, for a whole set of years, but really just to look at all the decades and all the years and the taxable situation. RMDs come in, and we already went over the ages of them, and then QCDs, especially if you're donating anyhow. I mean, it doesn't make sense tax wise to start donating to get a tax benefit if you don't really get anything out of the donation. So you need to be charitably inclined, but once you're there and you have a desire to do this makes a whole lot of sense. So another strategy that we have up here is an annuity with a lifetime payout. So we have a lot of folks that are going to set up their IRAs or their 401k rolled into an IRA to have them set up maybe where the income starts at 73. It starts at the beginning of the minimum distributions. And then they're going to get a payout for life based upon the life of both spouses, if they're both still alive. If it's a single person, then it'll be a payout based upon one life expectancy. So it'll give you a little bigger payouts. But the whole point is that we can set up an annuity with payouts where it has an uncertain term on it, because it's from the insurance company's perspective, they don't know how long they're going to pay you. Neither do you from your perspective, but you have the security in knowing you're going to get checks the rest of your life. And there's a way to match that up with these minimum distributions so that you don't have to worry about this in your later years. So that's about as far as I'll go with that. We have a buy long-term care insurance, and I looked up on the board. That is actually but long-term care, but it should say buy long-term care insurance. And we have one particular company that has a strategy all baked in place where you make one transfer from your IRA. You can cover two people. You also could cover just one person. And it makes distributions out of the IRA at the insurance company over into the long-term care insurance with a life insurance on the back end. And it's all set up, and it all just requires one transfer. And you don't have to mess with this thing. We don't have to mess with it over the years. And it's going to shoot out 10 payments out of the IRA into the insurance. And those payments can match up with RMDs. Now, people typically buy that before 73. When they do that, once they get to be 73, then those payments after 73 will count as RMDs. The next strategy that we talk about here is, well, it's really tied in with the other one with the 10-year premium. So I want to turn over to Tom. Tom, can you think of any more strategies, or do you have anything more to say about this?
I mean, one other thing that you could potentially consider, and ultimately that comes back to the why, like what is this money for? Is ultimately if this money is to go to your beneficiaries, another thing you could potentially do is start taking that RMD money out that you have to pay taxes on it and put it in potentially a life insurance policy as a premium that then goes to pay for a tax-free benefit to your beneficiaries. So that would be another strategy to do. Again, you need to be able to qualify through underwriting with the insurance plan. So there's not for everybody, but that would be something else you could consider. Ultimately, what we want you doing is thinking through your own strategy for how to make these distributions, and everyone's is going to be a little bit different. But sticking with the default of what the IRS lays out is not tailored to your situation is probably not the most efficient way to do this. And one way or another, it's very likely going to be starting to take money out prior to you getting to 73, because just waiting and taking it out then is just not a great plan to do.
Okay, and if you'll notice our board, and every one of the boards that we do in these videos covers the 7 worries with the check boxes. And a lot of the work that we do is really for people is taking all 7 of these worries or concerns or government programs you have to deal with and making them all mixed together and making decisions in all 7 of these areas, but then making sense of it and make them work somewhat harmoniously. So we're going to go over here. We talked about long-term care today, and we've covered IRA 401k. That's kind of what the whole show about RMDs is. We talked about income today. We talked about estate planning, and we're always talking about estate planning with beneficiaries and the taxation that a beneficiary is going to have to pay and the RMDs that beneficiaries are going to have. And then we talked about income taxes. So I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.